Okay, good evening, everybody again. I want to apologize in advance. Let me know if you can't hear me clearly because I'm not feeling too well. Having a bit of a flu and cough, as well as using a different laptop. So if in case you can't hear me, just write in the big chat and then we will see what I can do. Okay, so for the benefit of those that came slightly later, what I mentioned is that I have uploaded the TMAs. I think in general, the class did very well. Then average is close to 75%. Those that did not score too well, don't worry. The TMA in this module, fortunately, I would say it's a smaller percentage, so it's 15% only. And class participation is also 15%. So you can make it up by participating more in class, and you can make up for the breaks in the TMA. But I think at the moment, I'll strongly encourage you to focus on the GBA as well, because that one is quite a substantial portion. And the case, if you have started looking at the document, it's really quite long and it's very extensive. So yeah, it'll be good if you can work on a GBA. And from previous semesters, usually the submission of GBA, the quality of work usually is a bit heavier. So I'm writing like 8, 9, 10 pages of like explanation, etc. So it's a real full-blown project. So I just want to highlight that. And so before we kickstart the lecture, so the aim today is to first cover lecture materials. Last lecture we did a bit of this lecture because I mentioned that this lecture is quite heavy. So even with covering a bit of it, a bit over 20 slides, there's still quite a lot to cover. If you notice today's lecture, we have close to 90 slides. So the idea is that we'll cover the lecture materials. However, I'll try my best to cover the TMA as well. I'd like to go through the TMA questions and also answer any doubts that you have on the TMA. However, we might not be able to cover it. So at around 15 minutes before the end of class, I'll ask whether you want me to finish the lecture or do the TMA. So we might have to choose either or. But in that case, the aim is to cover both, right? If not, then we'll still do the TMA in the next lecture. So do not worry. But in case you want the understanding to help the assist in the GBA, then we can do the TMA as well. Okay, so there's a choice at the end of the close to the end of the lecture. Any comments, any questions so far? No, very good. Okay, thank you. All right, so let's start. In the last lecture, we kind of ended on a note on the quantitative component of forming a capital market expectation, right? So we covered a few things like CAPM. I think that was the last model that we covered, CAPM. And then we talked a bit about other quantitative tools like the risk premium approach that we see here, and calculating equity risk premium, etc. Right? So that's where we end up. So today we will kind of do a few more tools to form capital market expectation, and then after that we'll move on to quite a lot of qualitative discussion about forming market expectation, because most of the time market expectation is formed using a qualitative approach and then supported and substantiated by some quantitative calculation. So we'll focus quite a bit on the qualitative components. Many of the concepts I would say is not new, especially given that most of you are year 2, you might have taken an economics class, your economics professor might even have went through in more detail. So we'll not go through, we will take it from a finance perspective, right? But a lot of the concepts are not new. Okay. So that's the broad overview. And then there are some new parts that's kind of specific to finance. We'll think about things like, what is the what's the style of investment, what's the portfolio style. So those are more related to finance, and you'll see that at the end of today's lecture. Okay. So just to pick it off, let's just pull up the by 10. So previously we mentioned about the CAPM model, and we studied the CAPM model in year one, right? So that's the basic way to calculate your return on equities. Now we have this other model called the Singa-Tanga approach, and this in short we call it the TS approach. And basically the idea of this approach is that when we think about the market, right? So before we look at all the explanation, right, let's think about what is this approach about. So if we think about the market could be very open, like for example, Singapore, very open, people can flow in, goods can flow in and out, or very closed, right? And an extreme example of a closed market could be things like Iran, right? Iran is sanctioned, it's very close, everything is locally produced. So those two are very extreme examples. And so the idea of this approach is that we want to take into account this kind of differences within the market, whether it's a very segmented market or maybe it's a very integrated market, right? Integrated in the sense of like Singapore. Okay. So how do we take this account? We divide the two markets into two extremes. First, a perfectly integrated. Secondly, a completely segmented. Okay, and before we look at this formula here, right, I hope that you can kind of appreciate the formula first. And the idea is kind of very similar to a ratio. So this formula here, right, is trying to calculate what is the risk premium, so RP. RP, the risk premium in a perfectly integrated market, or a risk premium in a completely segmented market. Now, the idea that the risk premium is kind of like a ratio, right? So let's just write this here, right? Okay, so risk premium of I, which is the security I, right, is given by sigma, right? Sigma I. Sigma given is the standard deviation, right, which measures total risk. Now, we have a risk premium of the market is given by market, the sigma market, right? So the idea is that, actually, you know what, I should have written it the other way. It would be easier to see. Let me just rewrite this again. Risk premium of market equals to sigma market. Risk premium of I equals to sigma I. Okay, so the idea is that we want to find what's the risk premium of I, right? So can you see that it's just a ratio? So you take, so risk premium I equals to sigma I divided by sigma M times risk premium of market, right? So we see it's actually exactly this. Now, since it's just a ratio, which makes sense, the risk premium is kind of like just a proportion based on if it's a very risky kind of investment compared to the investment that's followed closely to the market, right? So it's just a proportion, as you can see here. Now, the idea is that in a perfectly integrated market, there is no kind of barriers to entry of different goods. And because of that, we have to add this thing called correlation, which is something that's not new. We talk about correlation quite a lot. The correlation of I to M, right? Because the idea is that it's so integrated, we need to consider how these goods correlate in different segments of the market, right? So that's why we add a correlation, as you can see here. So I hope that instead of just memorizing the formula or the ST approach, is just you memorize this formula, it's actually, the idea is very simple. It's just a proportion. Now, having understood that, you can see the explanation here. In the extreme, the other extreme is a completely segmented market. In a completely segmented market, what happens is that your correlation basically equals to 1, right? And the idea, okay, why in a segmented market correlation becomes 1 is because the investment is now fully correlated to the local market. So it's 100% correlated, right? Because it's very segmented. So local market, for example, let's say in Iran, it's everything within Iran is all correlated, right? Your investment and all your market movement in Iran, it's all correlated together. And so because of that, your correlation becomes 1. And so we get this formula here, which is a simple ratio that we have seen. Yeah. Any questions? So the thing is that we have a few examples. I think one example to use this formula. So guess there's no questions. So we can add this thing called illiquidity premium as well. In the next slide, we'll look at a question where we need to add this premium. Of course, we know that what I mentioned, completely segmented and perfectly integrated are two extremes. Most of the time, we have a percentage of each market, right? So we need to do a degree estimation. So what percentage is a completely segmented? What percentage is a completely perfectly integrated? Okay. Then we do like almost like an average, weighted average, and then we calculate the risk premium. Okay, so this is I put a star here. This formula calculates risk premium. Okay, I put this is risk premium only. Yeah. So most of the time, question asks you what is the return on equity. You need to plus risk-free rate. So in the previous semesters, there was a question like this in the finals, and people forgot to add this one, right? So the thing is that you kind of lost like I think it was like 4 marks, right? So it's wasted marks. So I'll say, please take note, this is a risk premium only. So if they want return on equity, please add the RF here. So we have a question here. We have analysts that estimate the Sharpe ratio of G or GIN is 0.28. The risk-free rate is 3%. Now, for a US real estate, he estimates that the standard deviation is this. Okay, standard deviation measures the risk, and the correlation with GIN of 0.5. There's an illiquidity premium. And the idea of illiquidity premium, I think we discussed in the last lecture. Remember, it's because you can't sell the securities quickly, right? It's not very liquid. The market, especially for segmented market, is usually a bit higher. Assuming that the US real estate is 70% integrated, so we know that it's not perfectly integrated. Estimate the expected return. So please remember to add RF at the end. Okay. So we take the two extremes now. So first, for perfectly integrated market, remember perfectly integrated, the formula was we need to take the Sharpe ratio multiplied by the standard deviations here and the correlation, right? And in this case, the correlation is given at 0.5. So we did this. Now we need to add the illiquidity premium. So we add 0.3. So we get this. Now, in a completely segmented market, the same thing, however, we just do not consider I'll just use a different color here. We don't consider correlation. And so correlation is 1, right? Because it's fully segmented. And we get this. And given as a 70% integration, we take 10% of this and 30% of this, right? And remember, this is just the real estate risk premium. You still need to add the risk-free rate, RF. I guess there's no questions. Let's move on. So this is the kind of the end of the quantitative component. Let's now dive into more qualitative component of forming market expectations, right? And so I think even in any case in your GBA, remember the steps, right? We had the IPS, then we talk about some asset allocation based on portfolio theory, and then now we go on to more like, okay, so what's the expectation in the market so that it can help me substantiate, okay, I want to add more bonds, I want to reduce the sector weighing to with healthcare stocks or something like that, right? So now what we're doing is, are we able to form some expectation in the markets which will help us or aid us in our asset allocation? And as I mentioned way back in the first lecture, at the end of the day, what we are the point of view we are taking is that we are a portfolio manager. We're helping a client manage of the funds, right? And so we need to consider all aspects. We did also talk about some, talk about psychological barriers, maybe even the tax. Remember, we talked about some tax considerations, etc. Right? So now, to form market expectations, usually the market is driven by inflation. And this is a big topic since COVID, or since 2022, after COVID, right? And before we dive into inflation, because I don't think it's a new concept, the idea behind it is that there's basically just too much cash chasing too little goods, right? So a question to everybody: anyone follows the market and can't understand why is inflation so high now? So the question is, why is inflation so high? Why is there inflation issue in the market now? Okay, that QE is a response. Okay, but what actually is causing money printing? Okay, yeah, money printing can cause inflation. But in the current situation, actually, what's happening? Why is inflation so high in, like, yeah, the current state, the economy? Wars. Okay, yeah, there's a bit of consideration for wars. That's good. Maybe there's one more: supply chain disruption. Yeah. So in the late in 2022, somewhere in 2022, 2023, early 2023, there was quite a bit of supply chain. And when there's a supply chain, you can see that shortage of supply. So we are talking about more cost push, supply shortage. That's good. Okay. So I think those are good examples. The war as well, war probably caused a bit more supply shortage, right? So however, a big factor is actually due to COVID, right? So recall that during COVID, governments were giving up a lot of money, and and even you and I were beneficiaries of these cash, right? We got a lot of solidarity packages. We had lots of cash injected in the economy because most of us were either working from home. We get a lot of benefits, right? And of course, it's not only in Singapore, like a lot of other countries, especially in the US, the UK, even Europe, a lot of people are getting a lot of money. And the idea is that it goes back to this thing where there's too much cash, right? So everyone is collecting a lot of cash. At the same time, during COVID, we couldn't travel, we couldn't buy the stores were closed, consumption was low, right? So there is accumulation of cash, which result in a increase in the cash in the market, and hence pushing up inflation. And in the sense, almost like a demand pool, where we see that there is now a high demand for a lot of, now maybe not so, but like in 2023 there was very high demand, and that's why for certain goods and services, and that's why the inflation is going up. It's going up at the point of time, 2022 to 2023, right? So now, of course, consumption is high. um there was a bit of supply chain issues as well. Um, and the backbone of the whole issue was that a lot of people were getting a lot of money during COVID, right? So that we had too much cash. Okay. So when we face inflation, as usual, because we are trying to take the view of a portfolio manager. Now let's think, what is the best way to beat inflation? Um, the best now is cash, right? You'll see people say cash or money market. So I like to introduce this term, uh, money market. So money market is basically cash, right? It can be cash or cash equivalent. For example, it could be things like short-term deposits, which we know now, even in your saving account, you can get quite high deposits. And basically this cash, sorry, hedges against inflation, because as inflation increase, generally the government increase interest rate, and so if you put your cash in a saving account, um, the cash in there, it would gain the interest rate based on the inflation rate, right? So usually that's a positive interest rate. Bonds, this is very interesting. So bonds are, so price of bonds, P, is inversely proportional to interest rate, I, right? So the idea is that um, as inflation increase, interest rate increase, bond price decrease. And we'll have quite a big discussion on bonds in a couple of slides time. So let's put that aside. It's important consideration. Now, stocks do best when inflation is kind of like moderate, it's kind of expected, it's not too like crazy, right? So stock is doing usually does well here. Real estate usually have positive relationship with inflation, and this is also relating to interest rates, right? So when interest rates increase, real estate prices generally increase as well because real estate is usually linked to mortgages, right? So higher mortgage means higher price in your real estate. So these are some just broad asset classes, and the idea is that okay, if you are a portfolio manager, and you see that the market now inflation is very high, right? And you have expectation of certain things, right? And we'll talk about that certain things in a bit, but it's quite intuitive, right? So if you expect certain things in the market, then what do you recommend your clients to buy? Should you buy more cash? Should you buy more bonds? Should you buy more stocks? And so we want to dive deeper in this by doing a economic analysis, right? So basically what's happening in the market. Right? So the idea of economic analysis is that we want to try to understand any relationships between the economy and the market return, right? Any lead-like relationships, or it could just be a relationship. For example, inflation, interest rate with some asset classes that we want to recommend to our clients, right? This is just a small comment here that generally, if asset follows the business cycle, is usually has a higher risk premium, right? Meaning if the business cycle is going down, uh, then the stocks will go down as well, or the asset class will go down. And usually such asset that follow the business cycle um, would have higher risk premium. Okay, so the measure of the economic activity is the GDP. So I think in your economics class, you probably go into a lot of detail, real GDP, and then we comment on how terrible GDP is. But generally, people use GDP, all right, and it gives the amount of goods and services produced in the country in a given year. GDP per capita usually is being used because we want to control for population size, so that we are not uh, underweighing certain countries that have more population, high GDP. For example, case in point in Singapore. Right? So we can measure GDP in outputs. Um, sorry, no, we can measure the gap of the GDP or output gap when you take the actual minus the expected. Right? So the idea is that we want to understand the economic variables affecting the market returns. Now, in terms of economic analysis, we need to understand that there's this thing called business cycle, right? So generally, we through your historical data, we know that a business cycle is between 9 to 11 months. And by understanding a business cycle, we know where are we positioned in the cycle and what can we expect, right? So at the end of the economic analysis or even foreign capital market expectation is about forecasting, right? There's a bit of forecasting kind of um, thing that we try to do, right? We're trying to forecast what's happening in the future. Okay? So so we look at the business cycle, which is around 9 to 11 years. Uh, we know that GDP is generally more long term. Again, we look at some output gaps, whether it's the actual minus the expected. We see what's the whether there's any gap, and if there is a gap, we can form certain market expectation based on the gap of the GDP. So there's a small comment here. An output gap provides some information about any uh, inflationary kind of pressures, as well as any kind of objectives that the country would like to achieve or to close the gap. Okay, so there are more details on the business cycle. There's this, we start with the initial recovery. So the idea that initial recovery is, so after it went down, so the initial picked up of the businesses and the economy, right? At this point, usually, inflation is usually falling. The short-term rates are usually the lowest, and there's, kind of rising confidence in the consumer, although it's still low, but it's rising. Unemployment is still high, right? So usually at this point of time, bond prices are the highest, right? Because remember, bond price is inversely proportional to rates, and if rates are low and prices are high, stocks may rise strongly, right? In the future. So in the early upstream, that's where there's increase in consumption, decrease in unemployment, and inflation reduce even more or remain relatively low. And short-term rates remain usually stable. They're very stable. Bond price remains stable, but importantly, we need to buy more stocks, right? Because stocks will pick up in value as the economy swings upwards. So this is where we want to put our money in. In a late upswing, that's where business is very confident. Output gap has closed, unemployment is very low. Inflation starts to rise because there's more money now. People are richer, they have more money, and therefore higher inflation. Short-term rates also increase to cope with inflation, right? And this time, home price kind of fall and stock price peak. Now, in terms of a slowdown, so after the late upswing, we move on to now because of the high inflation, the high interest rate, whenever interest rate is very high, the economy tends to slow down, right? Because there's less money, people are more do not want to spend too much, they are paying more in terms of interest, there's less discretionary kind of spending, and that's where business confidence kind of waver, business confidence kind of waver, company kind of reduce, maybe the inventory that they have, spending on discretionary items, like big ticket items also decline. Inflation continues to rise, bond prices, short-term rates peak, and the bond price will be at the bottom. At the same time, government bond price will be low because your interest rate is high. An important thing that we mentioned in the last lecture is that your yield curve actually inverts as well, right? So people are willing to pay more for the longer term yields instead of the shorter term yields, which is counterintuitive, right? Because when we have a longer term yield, the company is supposed to charge you cheaper, right? However, when the inversion of yield curve happens, the longer term yield now becomes more expensive because people are trying to hedge for the longer term. In terms of, and then we have some recession as well. Some issues are the next stage is more recessionary, where there's two successive quarter of decline in GDP. Confidence is the lowest, unemployment is highest, inflation falls, short-term rates will drop as well. But at the same time, with the fall in short-term rates, we expect bond price to increase. For government bonds, but for corporate bonds, especially for your small caps, we might expect some delinquency or insolvency in small caps corporate bonds, right? But government bonds are generally quite stable in a recession phase. Sorry, and so that's why money usually flows into your short-term treasury. So I'll just pause here. In terms of business cycle, we see there are kind of like a broad 5 categories. So a question to all of you, where do you think are we in the business cycle now? Okay, slow down. Yeah. Recession. Okay. Recession. Okay, so we have we are definitely not within the first three, right? Initial recovery, early upswing, and late upswing. So we're somewhere in like recession or slowdown. And that's correct, right? If you say slow down, yeah, then you can justify it. That's correct. Or you can say it's a recession, you can justify it. Some key characteristics that we can determine that it is a slowdown or recession is that we know inflation is still, especially for slowdown, right? Maybe between slowdown, of course, there's usually a percentage, right? How much or how it's not always a clear black and white slowdown or recession. You can somewhere in between, but we can see certain things like inflation continue, not really rising, but it has not fell yet, right? So if you look at the recent CPI or PPI, which is Consumer Price Index or Producer Price Index um, documents, we know that inflation has remained stagnant, right? So it's a flatlining. So we are somewhere between slowdown and recession. Um, at the same time, we know that short-term rates has kind of peaked. We have seen a slight decline over time, right? We have seen, even your fixed deposit in Singapore not paying as much as in early 2023. We see a lowering of the rates. So we are kind of like so that means we are somewhere here, right? There's a drop already, but we are not really a full recession as well. Um, Bond price bottom. So we noticed this in October 2023 when it was the lowest. So this is when we kind of know that 2023 there was a real possible slowdown, right? So I hope you are able to see that in these two slides, right? We are trying to give you tools to kind of assess the market conditions, and from the assessment that we have discussed just a minute ago, you can kind of form some expectations, right? So okay, maybe we're in a slowdown slash recession. So perhaps you know what? Um, a good investment strategy. So if you are a portfolio manager now, I recommend my client, see, bond price are at the bottom. Bond price is going to rise. So I'll recommend my client to overweight, overweight bonds, right? Because bonds are going to increase in price soon if we reach the recession. And of course, you need to justify it, right? So I hope that you can see why we're learning this kind of concepts and how is it applicable to choosing a right asset and applicable to the role of a portfolio manager. So there are various factors affecting the business cycle. Largely, they congregate among the consumers. So how much they spend, that's an important component. Of course, on the smaller aspect, we have things of the business and foreign trade as well, right? So, and when we talk about consumer, we are really talking about things like how much they spend, what's the confidence, because there's kind of like a reinforcement in the market, right? If the confidence is strong, it can reinforce and people spend more, etc. Right? On the downside, if the confidence in the market is low, consumers spend less, they save more, the economy do not grow so much. So it can't reinforce. Right? So the consumer rate plays a big role, so come 60-70% of the GDP in a country. Businesses, they can affect as well. They are small, they're more volatile. And then of course you have foreign trades, right? But US usually play a smaller component. However, it really depends on the demographic of the country. Like in Singapore, foreign trade, of course, it's a larger component total GDP. So government policies, we have someone already mentioned quantitative easing, QE. In general, we have two, so fiscal policy or monetary policy. So this is a bit more econs, most likely you already know this. So in terms of the fiscal policy is about spending. So basically, how much the government spend, right? And rate, tax rate cuts. So generally, fiscal policy, depending on the regime of the government, is tend to see is more a more long-term kind of mechanism, right, to affect the business cycle. Because cutting rates and increasing tax is not something, or increasing spending, you can still kind of do it quickly. But when you think about rates, tax cut or tax increase, usually there's a good lead up, right? You need to get public support. Like the recent GST increase, it took a while, right? It's not like an overnight thing. So they are generally a bit slower, more long-term kind of policies, right? Of course, but increasing spending can be more short-term, where you just government increase the spending, let's say in construction, repairs of roads, government infrastructure, and those roads. It's part of the fiscal policy to stimulate the economy. So you can either cut spending to slow economy or increase spending, like where I say increasing infrastructure projects to stimulate the economy. So there's some small comment during recession, your deficit can increase. In terms of monetary policies, and this is where it's usually policies that the central bank or MAS kind of employ. Even though in Singapore it's quite interesting, so the MAS has a very specific mechanism. You can read about it. Just Google monetary policy in Singapore MAS. You'll see that Singapore has a very specific mechanism using foreign exchange. So that's interesting. But in general, the idea is that we want to affect interest rate and money supply, right? So when you increase interest rate, money supply decrease. When you decrease interest rate, money supply increase, and this will directly impact either inflation, and of course the business cycle as well. So a stimulative measure would be to reduce interest rate, so increase money supply, when the economy is weak, and the reverse is you rise the interest rate and decrease money supply. So how money supply is being affected is using this thing called overnight open market operation, where the MAS actually reach out to bank to actually take some loans. It affects the amount of supply that is in the market, right? So let's say the Fed or MAS take more loan from the banks, this reduces the money supply in the market. Right? So it can be things like overnight loans, short-term loans. Okay. Any comments or questions so far? I think we're good. Okay. So government policy, we have two, fiscal and monetary. So we can either tighten, if you tighten both, the economy will slow down. If you loosen both, the economy will increase. Now, there's this thing called the Taylor rule. And the idea of this rule or this calculation is, okay, so we know that there is a target kind of like interest rate, right? So we want to try to reach the optimal interest rate. So before we look at these details here, the idea is that we want to have an optimal interest rate in the market. So how do we get that? So we need to start with a neutral rate, which is the rate which is the target rate for a given target GDP growth, right? So this is your neutral rate. Now the idea is that we want to incorporate 50% of GDP kind of like component, and this is forecast minus the trend. And we want to include 50% of kind of inflation component, where we take the forecast minus the target. And so 50% of each will give you, plus your neutral rate will give you your optimal short-term interest rate. So that's the idea. So you have something, a base, a neutral, plus 50% of GDP, plus 50% of inflation. That's how we get our short-term, prima short-term rate. So if your GDP growth or inflation rate is below the trend, so they are below the trend of the target, then it will motivate the central bank to lower the short-term rates. Of course, lower short-term rates encourage more borrowings, encourage more spendings. Bond price will be high, stock price will be high, and kind of like stimulates the economy. Okay, so this is a simple example here. We want to use the Taylor rule to estimate the short-term rates, rate level, and given for the given target. So we're given the following. We have a GDP trend slash target and inflation. So these are both the trends and target. We have the forecast, which is what we have placed here. And we are given the neutral rate here. So we can calculate the. So the idea is that nowadays in the market, I think if you're following the trends in the market, what people are really talking about is this thing called the neutral rate, right? So yes, we have this Taylor rule, and the idea of Taylor rule is it's good to understand, right? But what's happening in the market, a lot of chatter on it is what is the neutral rate now? Because people are saying that yes, okay, we can calculate the optimal rate based on GDP and inflation. However, what happens if neutral rate actually changes? And this is the concern of economists now, that the neutral rate has shifted so much so that the contribution of GDP and inflation is actually overestimated, right? We are being too bullish of overestimating the contribution from GDP and inflation, simply because more of it is due to change in neutral rate. Okay, so now when we think about this thing called trends, I want to highlight that usually this is considered more long term. So when we think about trends, we should think about it as more long term kind of movements. So when we see GDP trends, long term economic growth trends, these are more long term. And with these trends, usually we can do things like this called the cash flow model to calculate our investment returns. So components of some more long-term growth trends includes labor market input, either the size of the input or the productivity, right? The growth of actual and the potential size change in the input. So that's why whenever if we look at inflation reports, the first, not the first, but the first few line items they talk about is usually labor input, because that would contribute to your trend, your long-term inflationary trend. Next, we talk about the labor productivity. So how much is being produced. We have this thing called the total factors of production, which is more like a economic concept, and the growth of certain capital inputs as well, like investments. So the idea is that if we identify certain trends, these trends are more or less that kind of stable and constant, and this will give us more of our strategic asset allocation. So I hope that you can see I'm linking back to asset allocation. So it's strategic asset allocation, right? Your SAA. Because trends are more long-term, more stable, and this will give us strategic asset allocation. Of course, we do some tactical asset allocation, TAA, as well. And these are usually more shocks the economy, certain policy changes that affects your practical asset allocation here. So there might be some pro-growth kind of government policy. Of course, a pro-growth would stimulate the economy. Uh, sorry, with less intrusion in the private sector. So you can think of pro-growth as something like in Singapore, where pro-growth, there's as little kind of government intervention in the economy, as well as there's quite a lot of positive incentive for certain, whether it's not business or certain fashion in the Singapore economy to encourage growth in that sector of that space, right? So let's take like human capital development. We have quite a bit of scholarships. At the same time, if you're in the finance industry, you know that there's this IBF, uh, and this is created by the MAS, which provides training for finance professionals. And the scholarships provided is very generous there, right? So these are like build human capital in that specific space. Our tax policies are also relatively low and very stable, very easy to calculate, like our corporate tax rate is 70%, flat, very easy, right? Now, there are some more quantitative kind of economic models to forecast the market. So first of all, they include more econometrics kind of model. So the idea of econometric model, so of course you do not need to know how to do it, but it's just more of conceptual to kind of understand. So more econometrics model includes things like include variables. You create a regression. Usually, econometrics model, you do various type of regression. You try to reduce the amount of noise in the regression to give you a relationship right between the variables. So it's kind of like the idea of econometrics model. And with this, we are able to forecast certain recession or maybe expansion phase. There's some leading indicators. So these are indicators that leads the market. And we might have certain checks in terms of subjective kind of opinions on the market. Let's see a coin reduced to 15%. I guess you're talking about the IBF, right? So the challenge at the end of the day of forecasting is, there's this comment say, rubbish in, rubbish out, right? So there's some limitations to maybe even your data points, accuracy of the data. There might be certain biasness. As you can see, the survivorship, appraisal kind of bias, limitation of historical estimates as well. They, might not reflect the current day situation. There are some bias, kind of again psychological threats, some correlation that we not consider, and of course some uncertainties. So generally, as we try to form market expectation, we are forecasting the future. Hopefully, we're trying to forecast the future. And we need to understand that there are certain limitations, right? So you kind of need to, the idea of the challenge is that you need to hedge your downside risk. Hedge your downside risk meaning that, okay, you recommend certain asset allocation based on your based on the market. However, let's not put all eggs in one basket, right? Let's do some risk management to ensure that your downside risk is being hedged or is being taken care of, so that in an event that in the black swan event that happened, something happened, and your position doesn't fall, at least you have some hedge of the risk on the downside. So when we talk about hedging of downside risk, I like to mention this thing called not this thing called things like insurance policies, right? So sometimes you can even buy insurance policies in the market. We will talk about this in the next lecture on risk management. but we can buy certain insurance policies on our investments, which help us hedge our downside risk. There's a very interesting ETF. It's called Black Swan ETF. I'm not sure if any of you all have heard of it. So it's called Black Swan ETF. Basically, this ETF tracks Black Swan events, and when they do happen, the ETF goes up. Of course, now the ETF has not gone up since the Russian invasion of Ukraine. I think it went up during the Gaza invasion as well, the Israel-Gaza war. Other than that, it has not went up. So those instruments kind of help you hedge some certain downside risk if you are concerned about political kind of or geopolitical risk, and buy certain ETF to hedge that. Right. Of course, if you think about things like election and all, there are other kind of instruments that could hedge on political risk as well. Okay, so economic effect on asset class return. So we have talked quite a bit on cash and cash equivalent or money markets. So the money markets generally reflects the kind of risk profile. They are considered low risk or no risk or risk free. And the idea is that there are no credit risk involved. Right? So something a bit more personal. Nowadays we have a lot of fintech, so a lot of fintech companies, and you notice that this fintech investments, they are actually giving you like 5%, or in Singapore like 3.5%. So the interesting thing is that this kind of, they call it short-term investment. There's a lot of different names for it. Some of it called GIC, guaranteed investment capital. There are many fancy terms, but the idea is that most of the time these investments, which guarantees 4 to 5%, they are kind of investing in your short-term treasuries or short-term bonds, which are kind of considered risk-free, right? Risk-free. That's why you can get such high returns. And they are not just simple money market instruments, right? Simple meaning like FD, right? FD is a very pure play kind of money market instrument. But when you see fancy product names that give you like even better return than let's say your FD, they are usually in place. The underlying instrument is usually a short-term treasury. So if you go into like Simply Stash, I'm not sure if some of you use that, Simply Stash, or even what's that? Coinbase, cryptocurrencies, or things like Mumu or Tiger, they do offer such low risk or principal guarantee, and usually the underlying is a short-term treasury. Yeah, I see a comment on say Ukraine war effect. Yes, so the Ukraine war did actually affect the stock markets as well. So those are factors to consider in your asset allocation, say, for the manager. And since we're talking about short-term treasuries, they are generally called default-free bonds. So these are the same thing as short-term treasuries. So the idea of these default-free bonds is that they are generally from like developed countries, usually the US. Even in Singapore, we have some short-term treasuries as well. The idea is that we provide some inflation hedge, simply because when inflation increases, interest rate increase, you're still getting high coupon bonds, so you are kind of protected, right? They are fixed income instruments, so you're getting fixed income on a semi-annual basis, so you kind of are protected by inflation. And case in point, it was like the principal guarantee instruments, right? That I mentioned earlier. So they're kind of like default free, risk free, and you get high returns as well. Typically, they do best in a high interest rate environment because these instruments, the underlying of these instruments are short-term treasuries, and if short-term treasuries are paying well, your principal guarantee kind of instruments or risk-free instruments will pay you very well as well in terms of the interest rates. So at this point, I want to highlight that we need to consider the bond yield as well as business cycle. I hope you recall the last lecture where we did quite a bit of discussion regarding the inversion of the bond yield curve. So the idea is that if we if you want a real kind of like default free bond, okay, we need a short-term treasury. However, some treasury bonds, or not some, but most treasury bonds are actually quite or are long term. And when they are longer term, we are exposed to things like duration. Remember, I mentioned duration is the change in bond price, the sensitivity of the bond price to interest rate and also convexity, right? So that's where it increasingly becomes important to consider the bond yield in the business cycle if we go to the tail end of the bond yield curve. Being a longer term bonds, you need to be more cognizant about the duration and the complexity of it. So if you are holding short-term treasuries, generally the duration is shorter, your complexity is smaller. So the fluctuation with interest rate is low, right? So it's low. So there's not really too much effect of interest rate on your short-term treasuries. That's why I consider risk-free. Uh, have to comment here. Inflation rate affects stock price. Yes, we earlier mentioned that when inflation is predictable, generally stock price increase. When inflation is unpredictable, generally stock price do not perform too well, right? We have this thing called TIP, TIPS. So why? So when inflation is ex kind of expected, we mentioned earlier, when inflation is expected, the market knows where interest rates are being placed, right? So when inflation is stable, interest rates are generally stable as well, meaning that the market is performing well. So investors who want a stable return would go to bonds. Now, investors who risk are risk takers and want to take more risk to go to stocks, right? So there is a very clear distinction on where to allocate your portfolio. And that's why stocks, people that are more risk takers, they just flock to stocks, stock price might increase. Now, the issue is where inflation is not predictable. And that's where the market goes a bit, I'd say, crazy, in the sense that you don't know how to price in the inflation. And case in point is something that's happening now, right? We have very stable CPI and PPI indexes, which suggests that inflation is now either on the down or at least stable at the moment, right? So when inflation is stable, we do not know what is the next step of our central bank. Is the central bank going to cut rates because inflation is going down? And if they are going to cut rates, when are they going to cut rates, right? Because when you cut rates, what happens? Your money now flows from, this is a good question, our money now flows from short-term treasury away and into maybe stocks, equities, right? Because when the Fed or central bank cut rates, your short-term treasury rates are going to decrease. And if you want to get a higher return, let's say as a risk taker, we need to shift our money. And when there's this shift, sudden shift in the large sum of money, we can actually push up either the stock price. And because of that, it is very unexpected. We do not know what happened. So that's the to your question. Before we go for a break, let's try to cover this tips. So tips are inflation, bond linked to inflation. And the idea is that this bond will move in the same direction as inflation. So it kind of hedges against inflation. So if you're afraid that inflation keeps on increasing, you buy tips or inflation link, bond linked to inflation. And the thing is that if the inflation increase, your bond price increase, and therefore it helps you maintain your purchasing power. Okay, so there's some comment here for this. This is it's a special kind of bond, so it's called TIPS. So this special bond, the yield of this bond will fall if the economy is weak, when inflation is volatile, and the institutional demand is related to the and supply. Okay. So there's this last comment here about index. So the idea is that what this small comment actually basically trying to say is that an index bond is the same, moves the same direction as a actual support bond, right? Because nowadays, most of the time when we think about buying bonds as an individual, we normally buy index bonds. And this it can be an ETF of bonds. So very popular ETF is let's say TLT. So TLT is a ETF of long-term bonds, right? Long-term treasury bonds in the US. So instead of buying the bonds, because bonds are very expensive, you need millions of dollars to buy one bond. The idea is that we buy an ETF or index fixed income instrument like the TLT, and basically, as all ETFs, they try to move in the same direction as the actual underlying securities. Okay, I think it's already 1 hour. Let's take a short break. Let's come back at 8, let's say 8:10, 8:11, and we'll continue. If you do have any questions, we have to chat. Right, so we'll come back in around 7 minutes. All right. Welcome back. Okay, so I did see maybe it's a private message. Whether today's class is relating to, let's say, any other modules that you have taken, specifically those in taken in the year one, two, or three. No. So today's class is more on. I'm not sure. Do you all take a econs 101 class? You all have to take a econs. Um, I know my time I had to take econs. So this is relating more to econs. At the same time, of course, quite a lot of new concepts on things like bonds. Because in the 203 class, we cover bonds, but not in so much detail, not like this. So question, did you all take a econs class previously? Yes? Okay, okay. Yeah, so in year one, yeah. So just to get a sense, like all these things, the discussion that we had about GDP and all this is something that you know, right? Like you have been covered before in your econs. Monetary policies, fiscal policies, money flow, yeah, all these are all covered. Yeah. Okay. Okay, that's good. Yeah. So it's a bit on econs class. Okay, that's good. But I guess the a bit of new stuff will be like things like the Taylor rule, um, or the ST approach, like all this kind of, or maybe even the debt. Those are a bit more maybe useful. Those of you. Okay. Okay. So let's go on to defaultable bonds, or basically bonds that are not treasuries, right? So they include your corporate bonds. And it might even be like your treasury bonds, but from emerging markets. So the idea is that whenever we have bonds, we have the treasuries. So treasuries are risk-free. Now, once we go on to the domain of corporate bonds, this is where corporate meaning is from like big companies, like for example, Keppel. Keppel is issue bonds as well. Sembcorp issue a lot of bonds. So some of you all might know Sembcorp. They issue a lot of bonds. So these bonds usually has default risk. Default risk meaning Sembcorp can go bankrupt. Very unlikely, but they could. And when this happens, um, of course, you as an investor would not get your money back, right, in a bond situation. And so, because of this risk of default, generally the returns of corporate bonds are higher. So higher risk, higher returns. Now, if we move on away from corporate, so in corporate bonds, what is not written here is there's this thing called small cap capitalization or large capitalization, right? So large cap. So based on your corporate bonds, you can divide into two. Is your company that issuing the bonds large companies or small companies, right? So large companies, you can think of MNCs, small companies, generally SMEs do not really issue bonds, but they can be like just smaller in size, right? Smaller companies in terms of market capitalization. But they still could be considered like a MNC, right? Maybe small names that you have maybe never heard it, right? So we can split into large cap and small caps. In terms of emerging market kind of bonds, they relate to um, emerging markets. But they are treasury bonds. However, because they're emerging markets, they do have a risk of default, and therefore we have a higher risk premium on that as well. Now, the thing about emerging markets is that because most of the time, the currencies in the emerging markets are not um, easily traded. Sorry. So what happens is that they usually trade the bonds in euro or in US dollar, right? Easily traded currencies. And because of that, they are prevented from printing money to pay off their bonds for the bond holders. And this gives the bond value. However, it's not to say that the emerging countries could go into a default situation. So they could default their bonds as well. And therefore, bonds from such emerging markets usually have higher returns. They can even be higher than the corporates, because they depending on the risk profile of the emerging countries. So some economic effect on asset classes. Um, Most common is equities. So generally, just now we talked about how equities are good to buy when inflation is kind of stable. We know the direction where inflation is going. Um, and there are some other various things to consider: profit versus GDP, PE ratio, and then what stage of the economy is in. Now, this is probably what most of y'all know the most, right? Because equity, right? When you think about stocks, equity, this is one of the most. However, I'd like to highlight the idea of real estate. So real estate is a alternative investment. They are not traditional investment, they're considered alternative investment. Generally, real estate hedges inflation risk. And the idea is that um, real estate prices are linked closely to mortgage interest rate or mortgages. And therefore, when inflation increases, mortgage rate might increase as well. And therefore, your real estate prices increase. So that's the general concept of why real estate hedges against inflation. Now, in terms of currencies, I think there was a question regarding currencies in our second lecture. And the idea is that, oh, does inflation affect FX or something around that line, right? And then I told the whole discussion, I have explained that we must be very careful with currencies because currencies do not directly impact your inflation, nor does it directly impact um returns on the markets. So we need to be very careful because how currencies or FX are being determined is based on things like you mentioned here, purchasing power parity and relative strength of the economy. So based on the relative strength, based on purchasing power and FX rate is being determined, right? For example, US dollar versus Sing dollar. Yes, there might be some effect on certain economic policies affecting the interest, not interest rate, but the FX rate. However, they are very indirect. So you need to be very careful that there is not a clear relationship between FX and returns. Of course, when your currency is low relative to the other country, your products are cheaper. There's more investment because products are cheaper. There are more investments in your country. Um, but at the same time, your citizens in the country will not have a lot of spending power, right? Because your FX is low. So it depends. It works the other way as well. If FX is high, your citizens have a lot of spending power relative to the other country. However, products are expensive now. The other country can purchase. So FX is foreign exchange. Sorry, for those who do not know, FX is foreign exchange. FX rate, foreign exchange rate. So Sing dollars to US dollar. That's exchange. Okay. Now we have talked quite a bit on the forming market expectation. Let's think about investment styles. So as a portfolio manager, you have various styles, right? And there are two extremes: active style and passive style. Passive is like your indexing or ETF, and active is like your hedge fund managers, right? Of course, nowadays there are the whole suite of in-betweens. And sorry, let's try to understand the two styles first, the two extreme styles. So on the one extreme is a passive style. So idea of a passive style is that you want to track certain index, right? You want to track certain portfolio, let's say S&P 500. And when we're doing such passive style and we're doing a tracking of, let's say, a portfolio of, let's say, S&P 500, the idea is that we want to minimize tracking error. And as the term called tracking error means that there's an error in the tracking. Because you're tracking something, right? But there's an error in the tracking. Meaning what? Meaning that instead of you following 100%, maybe you follow 80% or 90%, right? So there's an error there. And this is measured by the analyzed standard deviation of the difference between the portfolio and the benchmark of the portfolio I'm trying to track. Okay. So in such passive style, there could be some form of active management also, right? And when there's some form of active management, they have this thing called active return based on the portfolio. And this is measured by this thing called information ratio here. It is the active return divided by your tracking risk. It represents how efficient the portfolio's tracking risk delivers active return. So the idea, okay, let's just think about it, right? Because it's quite a lot of words here. The idea is that, okay, I'm doing passive management. However, we know that even in any passive management, there can be a small form of active management. And this small form of active management is calculated or translate to this thing called the information ratio, which provides you, what is the return based on active management. However, this amount is small because you are a passive management kind of manager. At the same time, your tracking errors is small because you are trying to track the management as much as possible. And as a passive investor, the idea is that you believe that the market is efficient, you believe that everyone should, on average, on aggregate, should get market returns, and therefore you have to just check the market, let's say S&P 500 or VOO, right? Or NASDAQ. Yeah. So a small comment is that the disadvantage is that you can only get market returns, right? Yeah, you only get market returns. Now, on the other extreme end, let's think about active management. So the idea of active management is that, okay, if I actively pick stocks and trade the stocks, I can actually outperform a benchmark, right? And this benchmark could be, let's say, SP 500 or NASDAQ. And the idea is that the way I can outperform is through superior skill, stock picking, tactical asset allocation, everything that we kind of like discussed previously, right? And this will give you higher returns in S&P 500. Now, the concept is that an active investor thinks that the market is inefficient, and if you do very good research, you can actually outperform the market. So, empirical evidence suggests that, yes, as an active manager, you can make some positive or so alpha returns, where we measure this word alpha. So you can make some alpha returns. However, on aggregate, on a long-term basis, 5 years, 10 years, on average, you tend to just make beta returns. Beta returns mean systematic returns, meaning that you do not outperform the market, right? You just make market returns. That's what empirical evidence suggests. Now, nowadays, most people are not the extreme, passive or active. They are somewhere in between, and that's where we see this thing called semi-active. And the idea is that they track a certain profile, like let's say S&P 500, a portfolio of those. However, they do some stricter asset allocation to overweight certain sectors. Right? In our current situation, if you are following the market, we know that tech stocks are doing really well. And specifically tech stocks in the AI sector, right? Things like Nvidia. So for our Muslim students here, you know that there is Sharia law kind of investments. So for those who are not aware, so Sharia law is basically a subset of investment strategy which follows a specific law required by Islam, right? And the idea of the Sharia law, okay, why am I even talking about this, is that The idea is that we remove a lot of seen stocks in our investment portfolio. And because they remove a lot of seen stocks include alcohol, tobacco, etc. Right? And when they remove such seen stocks, they overweigh technology stocks. And so if you go to Google and search portfolios based on Sharia law, and we're talking about diversified portfolio, right? We're not talking about like individual stocks or not individual, but like very concentrated portfolio. But if you go to look at diversified portfolio of the Sharia law version of, let's say, S&P 500, you'll notice that they should perform even better than S&P 500 simply because there is an overweight of technology. And the idea why I'm bringing this up is that nowadays there's a lot of this called semi-active management, meaning what? Is that, okay, instead of just making a portfolio based on S&P 500, how about I overweigh technology? Or how about I bring in portfolio based on Sharia law simply because it provides me some overweight in technology stocks. And these are kind of very interesting concepts that you can see in the market, right? So semi-active, of course, is the most popular nowadays when you try to outperform the market. Of course, any comments? Anyone like to add anything? Like personal experiences in managing your own portfolio or overweighing certain stocks? So maybe there's no comment. So there's just sorry, there's just some small comment here that saying active you want to keep track of any risks. You want to keep the tracking risk at acceptable level. At the same time, you want to maximize information ratio, which is what is the um, active returns, right? Because these active returns. Okay, so we have those three kind of investment styles. Now let's look at this thing called equity types of equity indexing. Okay, and okay, so let's think on idea first, right? We have various styles of equity indexing. And what does this indexing mean? It means that how is this portfolio created? And there are various ways we'll see, and there are examples here as well. So the first indexing method is, okay, I want to create a portfolio, but based on what? The first one is price weight. And it represents the buy and hold of one, this is important, one share from each stock or each component of the index. And it's made by the price of each stock. And the example is the Dow Jones Industry Average. Now, the index is basically the sum of one share of, let's say, 100 companies, right? Adjustment by the number of shares in the index. It's simple, right? It's very simple. It has a rich history because you just pick one stock, right? So you can actually see, oh, okay, this year this stock is here and this company is here, but next year this company is no longer part of the portfolio. And we can kind of like understand why. Maybe that year the market is not doing too well in this sector, etc. So we can kind of see it. Very rich history. The disadvantage is that the index generally, imagine you have a stock, right? And we talk about tech stock in Nvidia. It's crazy now. It's like so high. Nvidia stocks are like crazy. And you have just one Nvidia stock can help overshadow all your smaller stocks, right? That might not be performing as well as Nvidia. So it is biased for stocks with high price. At the same time, it is susceptible to things like stock split, reverse stock split as well. Can require some adjustments if there's any splitting that's happening. And also the weight is a very arbitrary, right? The weight is based on the stock price. That's about it. So we have an example here on this kind of indexing. So let's look at this example, a price-weighted indexing. Now, in this example, you are given two stocks, ABC, X, Y, Z. You are given the initial price, final price, the shares, the initial value outstanding, and the final value outstanding. Now, compute the return of each stock. So each stock is quite simple, right? You basically just say 30 divided by 20, 90 divided by 100, minus 1, given by here. Okay. Now, because we are doing price-weighted index, we are doing one stock only each, right? So you hold one share of each firm. So what does it mean? Initial portfolio, I'll use a different color. Initial portfolio is this. Final portfolio is this, 30 plus 90. Now, what's the change in portfolio value? Okay, not so difficult. You just take 120 divided by 125 minus 1. So we see that the change in portfolio value is this, minus 4%. And in a price-weighted index, so when you see price-weighted index, meaning we want to look at the value outstanding. Sorry, not value outstanding. I mean, you look at the number of stocks and initial price and final price. So we have one stock of 25 and one stock of 100 divided by 2 because you have two stocks. The final price is the same, 30 plus 90 divided by 2 because you have two stocks. So now the change in price is also negative 4%. So either you do the portfolio of one stock each and the price weighted index, you see that the change is the same. Because the idea is the same. You're just saying one stock of ABC and one stock of XYZ. Okay, so we have the next index we talk about is the value weighted, and this is the one that nowadays most people use, right? Value weighted. So what does this mean? It means that you buy a portfolio and hold the outstanding shares of each component, and you weigh them based on market capitalization. So every time some certain things or certain stocks increase in too much value, we need to do a rebalancing, right? So reduce the number of stocks to make sure that the market capitalization of, let's say, tech sector doesn't exceed the percentage that we have set, maybe 40%. So it doesn't exceed that. So how does this index work? You take the total value of index component divided by total value as of some baseline given, right? And usually the baseline is like, let's say 100 as a starting point. Nowadays, there's this thing called floating weight index where the weight of the stocks equals to the market cap multiplied by the floating weight. There's this factor that we adjust, right? We adjust based on a floating weight adjustment factor. We have an example in the next slide, so do not worry if you are like a bit lost. What's this? So the concept is that you just create a portfolio based on the market capitalization, right? And you want to make sure that you ensure this percentage, or let's say in tech, in consumer, remains consistent based on market capitalization. Advantage is that index is self-correcting. If there's a split, you don't care because you just look at market capitalization, right? If the market cap drop, then you need to buy more of that stock. If the market cap does not drop, you don't like to buy more. Now, floating weight is generally considered a gold standard now. Like your S&P 500 use floating weight. Of course, there are some restrictions in terms of concentration risk, in terms of number of stocks. Some disadvantages is that they are biased towards companies with large market cap. So nowadays, your tech stocks have very large market cap. You tend to see a shift in S&P. If you track the S&P holdings from the 1990s to 2000, you notice that there's a shift in the S&P composition towards tech because they are biased towards high market capitalization or large market capitalization stock. And as the year progresses from the 1990s to 2000, there's an increase in tech stocks that are performing well and having a larger market capitalization. Portfolio may be concentrated in relatively few issues, and also if there's some regulatory concentration risk in current regulations, then we can't have such indexing, value-weighted indexing. So we have an example here. Again, we use the same example, XYZ, ABC stock. Let's compute the return of each stock. This one is already done in the last example. We'll not go through. I just do it individually. Now, let's think, what's the return on a portfolio that holds 10% of each shares for each firm? Okay, so we're doing 10% now. So in the initial price, we have $25 per share. You are only going 10%, so you need times 20 million times 10% plus 100 times 1 million times 10%, right? So the working is here, 60. We do the same for the final price because we are only having a portfolio of 10% share. And we can calculate what's the change in portfolio value here, given here. Now, if we do a value-weighted index normalized by initial value of 100, so we need to normalize it. The idea is that, okay, we have 600, so initial value of the portfolio, 600. You divide by, what's the initial value? 600, right? Times 100. So you normalize it at 100. Now, the final index value is 690 divided by initial is 600 times 100. So you get this. And our change index is 15%. Any questions regarding the calculations? Yes. Okay, I guess the calculations are kind of simple. It's really about really understanding the concept of what does this really mean, right? Now, next you have this thing called equal weighted. So this is, kind of like you just make sure 50-50, right? Equally weighted. Represents a portfolio invest in same amount of money in each component, weighed by the stock as the utility. Disadvantage is you bias towards more stock because if it's a big stock, or it's a big company, then you have less of that, right? Because you need to make sure it's equal. But let's say you have a small company, you need to buy more of that small company stock, make sure it's equal to one big company stock. Right? So it's biased towards small company. Frequent rebalancing and small stock may not be liquid, right? If you're buying small stock companies, they may not actually be liquid. This, in a sense, is kind of like the simplest one of the calculation. Again, we have the same company. I'll not go through, I'll not go through how to calculate individual stocks. Let's look at part 2. The portfolio that invests 30 million in each firm. All right. So 30 million means that the initial portfolio that we have is 60 million, right? Because we're equal, 30. Now, what happened to the final portfolio? So final portfolio, we have 30 million. So we invested 30 million divided by initial price times final price of 30. So this is what's the final value of portfolio for ABC stock. Now for XYZ, we invested 30 million divided by 100, initial price 100, times at the end 90. This is the final price of portfolio. Our return on portfolio is 65 divided by 60 minus 25%. All right. So now if we do a equal weighted index normalized at initial value of 100, what does this mean? It means that we start with 100 divided by 2, because remember equal weighted, right? the initial value is 100. So we are buying $50 or 50 million in ABC, 50 million XYZ. So our initial price is 100 divided by 2 equals to plus 100 divided by 2. I put a star here because I think previously I received some question like, how come 100 divided by 2? So remember, we are doing equal weighted. So our normalized initial value is 100, meaning 50 is in ABC, 50 is in XYZ. So equal weighted. Now, what happens at the end? So we have 50 times, how we get 1.2? So 1.2 is 30 divided by 25, right? Which is given by here. 30 final price divided by 25, 1.2. Times 50 plus 50 times 0.9. So how we get 0.9? 90 divided by 100 equals 0.9. And you times 50 because we buy equal weight at 50-50. That's how we get this, 105, and then we just find the variation. Right? Any questions? So we are done with index, right? We're talking about index. So just a quick recap, right? We have covered actually quite a bit. Like in this forming market expectation, we really talk about quite a bit of things. We initially talk about some quantitative methods for calculating expected returns. We did some qualitative. We did some we try to understand the index, really the benchmark, whether we have passive versus active management. Then we do some indexing, right? So next we'll talk about some passive investment vehicles. I'll pause for a short while. Any comments they'd like to add? Okay, maybe no. Right. So in terms of our passive vehicle, our most traditional is this thing called mutual funds. Some of you all might have heard of mutual funds or even might have already invested in some mutual funds from your uh, friends who are like insurance agents. They might actually try to sell you mutual funds. And the idea of mutual funds is the same as ETF. Basically, they are just a passive index portfolio. All right. Um, but the thing is, it's a bit more regulated, right? There is a board, there is a shareholder of these mutual funds, and they are usually sold through banks, insurance agencies. Now, what is more popular nowadays is this thing called ETFs, exchange traded fund, and I believe everyone has heard of it. And the idea is that between ETF and mutual funds, right? ETF is, I would say, a cheaper version of mutual funds. It is more tax efficient. You have to pay lesser transaction fee. It's easier to manage your own funds. You do not need an intermediary. You can just download Moomoo, you can download Tiger Trade, and you can simply just trade ETFs, right? So it's very accessible, unlike um, uh, mutual funds, right? So ETF are very accessible compared to mutual funds, which are usually more regulated through a bank, through an insurance agent. Uh, and generally, the idea is that when we do index portfolios, because there is less active management. Right? Uh, just an overview of how ETF works. You have a capital market security, right? You start here. You put it in you have an ETF advisor that creates the fund ETF based on XYZ securities inside. And then after that, they put it in the market and you can buy as an investor, right? You buy it from Moomoo, you buy it from Title Trade. Then, of course, when you buy, you give cash, and then the cash goes to the capital market. This is how it works here. This is a simple, very simple diagram to explain it. So, which ETF to choose? You can have a look. There's some comments to ask to question whenever you choose ETF to buy, right? What should you buy? Which you need to consider what securities, sorry, the way your securities, what kind of methodology, and you balance it, etc. So there's some consideration to buy ETF. This slide, you can just look at it. Basically, it's just saying there are various, they just comment on various ETF that you can consider buying. The popular ones are QQQ, TLT, these are bonds. This is tech heavy on Nasdaq. You can buy gold as well if you like. GLD. They don't have the S&P here, which is the DOO. Not here, right? So this is not investment cost, but if you do invest, do share your experience. So why should you invest in ETF? They provide some diversification. Mutual fund does it as well. Of course, stock picking doesn't. This one is very cheaper, continuous pricing. Now, mutual funds, the important thing is end of day pricing, right? Your funds are based on end of day pricing. It's also good because sometimes intraday, right, you can if you are a trader, you can capitalize on intraday movement, right? Intraday meaning within the day, like from 9 a.m. to 6 p.m. The price can keep on changing, right? So ETF, you can track this change and you buy based on, okay, the lowest of that day, right? Let's say I'm buying today. You can buy the lowest of today. Now, for mutual funds, unfortunately, it's end of day. Usually, you place your buy call by 4 p.m. and then later the bank will say, okay, we buy for you these mutual funds at this price as of, let's say, 5 p.m. that day. Something like that, right? It's end of day. There's no intraday movement, or you can't buy it the intraday. Sales charges, of course, this is less, ETF less. There's some sales charge, management fees, expense ratio. This is important. In case you are deciding to do some investments yourself, please look at your expense ratio. Basically, what this means is that what is the cost you're going to incur when you buy this ETF or mutual funds. Generally, mutual funds are higher in terms of cost. You trade through broker. This one, no, this mutual funds is upfront. There's dividends for it, right? So ETF, just a more common, efficient, transparent, and flexible. Okay. So since we're talking about passive investment vehicle, we need to think about things like what kind of replication are they doing? Are they doing a full replication or are they doing a partial replication? So full replication means all the stocks are being replicated, right? If you have 10 Apple stocks, you must have 10 Apple stocks in your ETF as well. So full replication, right? You minimize tracking error. Is the most common procedure for large funds. Stratified sampling replication means that you just divide the index along various dimensions, things like industry, and then you make sure that you meet the requirements for each industry, like 10% in tech, 20% in consumer, 5% in healthcare. So you make sure you just match the stratas, right? Because stratas or stratified cells, right? So each index stock is placed in a cell, and you make sure you need to ensure that the percentages in the cell are being met. So you can build a portfolio based on selecting random stocks and put them in the cell that is under this category. For example, healthcare. So stratified sampling generally allows greater dimension, more finer kind of division, provides more diversification. Right, there's some comments here. You can have a look at it. The next one is optimization. So this is, I guess, the most advance, right? You want to optimize. So instead of just picking strata instead of just doing equal weighted or full replication, not equal weighted, sorry, full replication, you just optimize it. So how do you do optimization? So optimization is that based on the risk exposure of the index and the individual stocks, you can come up with a model, like a model, you call it multi-factor risk model, or just like a investment model. And from there, you can determine, okay, based on this investment model, what should you invest in XYZ, what should you invest in ABC stocks, right? The objective is then to specify the proportion of each security and to minimize the tracking risk. So the good thing about optimization is that you can account for correlation, right? Correlation given by this or covariance. Remember, correlation and covariance are related using the formula. So we can count model the correlation between stocks. Unlike the stratified sampling, where you will just assume they are uncorrelated. You do not choose the stock based on correlation, you just choose it based on the stratas, right? Stratas meaning the cells. Healthcare, we choose it based on consumer, etc. But optimization, you choose it based on what's the most optimal way to, remember, reduce your unsystematic risk using diversification. We have an example here. David is considering investing in a mutual fund that is classified generically under growth and income. Using the available data, he gathered the following information about the mutual fund. What kind of fund is this? Okay, so we have a benchmark here and a fund. Now, immediately can you see something? Okay, we have a weighted average market cap. They're kind of similar. Now, number of stocks, they are very different. So remember there are three styles. So which one is definitely not the style in this case? Which is not the style? Remember we have three styles. So which one is not the style? Just based on the first bullet point here. Anyone like to give a try? Which is not the style? Remember there are only three styles. So it is not there. Full replication. Thank you. Yeah, that's right. Not full replication, right? Why? Because full replication means one to one, right? But we're looking at the style and benchmark. You have 80 stocks in a fund, the mutual fund, your benchmark is 600. So for sure it's not full replication. Thank you. Now, looking at the sector division here, which one is, so full replication is out. So based on the sector division, which style is being out? It's not this style anymore. Look at full replication. Oh, sorry, looking at the sector division. Anyone want to give it a try? So full replication is out. So we have two more styles. So which one is being removed under sector? Looking at the sector breakdown. So the stratified, right? Hope you can see that. Stratified is being removed. Why? Remember your stratas are based on, can be based on things like sector. And can you see your sector allocation is so different? Some of them are similar, most of them are not, right? So most likely your fund is optimization fund. All right. So those are passive equity management. Now let's look at active equity management. So whenever we think about active, right, active manager can do three things. And so this is just some comments, you can just read about it. But the thing about active manager is they do three things, right? They can either time the market, so choose when is a good time to enter. They can change the portfolio structure. So this is your tactical asset allocation, or they can do a selection based on certain concepts, philosophies, things like inflation projection. So like certain insights that they have for long term. Okay? So the idea is that we want to have these three, based on these three possibilities or vectors, we can kind of select and pick and choose the best fund to invest in or best stock to invest in, which will give you alpha returns or give you abnormal returns that's above the market. So you can earn more than just market returns, more than just S&P 500 returns. The assumption, underlying assumption is that markets is inefficient. So you need to have certain skill, you need to do some of your research to choose what stocks to invest in. The thing is that if you are right, you can actually earn a lot. So for some of you all that has or have invested in cryptocurrencies, Bitcoin, um, you have earned a lot by now. If you invested way back in 2022, when it was a big craze. If you have hold it till now, we know that the SEC has just approved the ETF Bitcoin, which caused the market go to be very positive on Bitcoin, and therefore the prices of Bitcoin has been going up a lot. Right? So if you have bought Bitcoin, you have done quite a lot now. Disadvantages is that if you are hesitant, like for example, you did not go into Bitcoin, too bad. You have lost, you have missed the boat, right? You cannot you can invest in Bitcoin now, but you are most likely on the high side. But if your expectation is Bitcoin is going even higher, okay, fine, maybe you can invest in Bitcoin now. Okay. Okay, so before we move on to this all active management, again, let's take a break. Uh, I know it's a bit heavy, a lot of different content because it's not so direct to just one talking about one thing throughout the whole lecture today. There's a lot of different components formulating market expectations. And so let's take another 7 minutes break. We'll come back at 9:07, and we pick it up from there. And let's push on to the last part of the lecture. I think we have around 20 more slides. And I think I mentioned at the start of today's lecture, for those that um, do not know, the TMA results have been released. So you can go online to check your TMA results. If we have time at the end of today's lecture, we'll go through the TMA. And the last 15 minutes, I will do a quick poll, see who wants to go through finish the lecture, or we do the TMA. Hopefully you can do both, right? So let's continue. Now, before we left on for the break, we're talking about active managers, active management. So the idea is that we are trying to select stocks now, right? We're active manager. We're no longer doing passive management. So we are trying to select stocks based on, again, the IPS, our investor risk appetite, and also our perception on whether the market is efficient in pricing in information. So whenever we do active management, we have active returns, and active returns are measured by information ratio. Okay. We are not so concerned about tracking error now because we're not tracking index, unlike a passive manager, right? So we are interested in information ratio. Now, in an active manager, we can segregate the investment strategy into two parts, right? Whether are we a value active manager or a growth active manager. So let's look at value first. The idea of value, let's just think broad base first, right? The idea of value is that these stocks are generally undervalued, right? They have very good fundamentals. They are expected to boom in the future, right? Or becomes very, very popular in the future. A good example of a lot of value stocks include things like tech stocks, like prior to the AI boom, people that invested in things like Apple, things like Meta. So if you invested in Meta um, back in 2020, 2021, you have earned a lot of money now. Because at that point in time, of course, we know that Meta is in the forefront of virtual reality, AI. And so if you're invested in Meta in 2021, prices are really low at that point in time. They were having quite a bit of legal issues. They were not doing too well, right? However, now they are with the promise of AI, they're actually one of the highest value stocks in the market. Nvidia is one other one, of course, but not not most, but some people might not know what's Nvidia, right? Nvidia produces the graphic cards and all, but Meta, I believe everyone knows Meta is. So Meta is a good example of value stocks. Assumption is that you have some view that a company is, not being valued correctly now at that point in time. And so you want to invest in these stocks, which will produce value in the future. Case in point, Meta. Uh, there are some stock styles in your value composition. We can think of it as, are these stocks more defensive or kind of out of favor stocks that people are doing like? So Meta is obviously not one of them. Meta is more like a glamour stock. I would say more defensive stock or out of favor stocks could be things like um what's that? The semiconductor industry, right? So unless you are really technical in engineering, you don't really know what companies are part of semiconductor. But we know that semiconductor or even district cooling. So district cooling is like things like your big cooling plants to cool your malls, to cool your convention center. So things like this, like district cooling, semiconductor, they are not very glamorous. They are more, you might consider them out of favor stocks, right? We don't really know much on that unless you are really in that industry and you know that. So these stocks could actually be value stocks as well. So there are some sub-styles in it if you choose these kind of stocks. And you have expectation that, let's say, we know that as AI progresses, we might need more district cooling simply because we need data centers, right? We might need more data centers, and these data centers require very specific kind of cooling systems. And if you know companies that are investing in such cooling systems, they actually might be value stocks as well. So these are potential value stocks that we can consider. They are not the glamour stocks that we talk about, as we see here, um, like Meta and Nvidia at the moment. There are some risks as well because these stocks are being cheap for good reason. Maybe the fundamentals of this company are not that well, or maybe the product value proposition is not so good. So that's why they are not valued high, right? So there are risks, I guess, based on how you want to invest. Uh, the second style I mentioned is growth style. So growth style focus on high earning growth companies. Um, Generally, they grow year on year, and you expect the growth to be continuous and on upwards trend, right? So investors generally don't mind paying more because we expect the company to grow even more, right? And because they grow even more, they create more value. When you create more value, you earn more in your portfolio. So assumption is that the growth of this stock will continue and the market will continue to reward these companies for growth. Uh, so some people consider new technologies kind of like a growth stock. Nowadays, it depends, right? So we in the following slide, you'll see as nowadays growth and value are a bit gray. Okay, but before we go there, let's talk about some sub styles in your growth stock. So some sub styles could include things like okay, what is the growth? Uh, how long has the growth been? Right? What's the historical growth? Whether are there any momentum factors that are in play? Um, and the risk is that the growth does not materialize, right? So maybe it has been growing for 10 years and then on the 11th year, it did not grow. The bottom line did not grow, or top line did not grow, right? Or it grew very small, and therefore the market did not no longer place a premium on the growth. So these are some risks involved in a growth style active management. Uh, so generally, these are two risks that I talk about. For value, is that okay, the stock is cheap because it's really lousy. That's why there's no value in it. So that's a risk. Growth is that okay, it has been growing, but maybe the growth stopped, or maybe the growth is no longer priced as a premium now because people expect the growth, right? After the keep on growing for 10 years, people expect it, they no longer price it as a premium. And therefore, these are the risks involved in having such styles. Of course, like I mentioned earlier, nowadays growth and value are quite fuzzy, right? So when we think about tech stocks, are they growth or are they value or are they both, right? Maybe they are both because there's value and they are growing as well, right? So Amazon, things like Amazon, Apple, they're actually both, they might be both value and growth or somewhere in between. All right. So we have an example here. Let's look at example. Um, Basically, one is concerned about the performance and investment position of an investment firm he hired years ago. So the firm has been tasked with managing an active portfolio with a developed market mandate. Now, one performed some return-based style analysis and found that the following results from past 2 years. What reasonable conclusion can you reach on the investment process? Now, just looking at this, what's happening here? Anyone would like to give a try? What's happening here in terms of the investment styles? So, for the interest of time, um, maybe it's not so clear, but what's happening here? Can you see that in terms as the year go by, right? That's why I put the arrow now. As the year go by, this is the portfolio, right? These are individual portfolios here for each year. Can you see that the investment in value has decreased over time? Investment in growth has increased over time, right? So we see a shift towards growth stocks. At the same time, a rebalancing as well, right? At the end of the day, we have a very kind of balanced 50, almost 50-50 value and growth instead of the initial very underweight growth stocks. So that's what we can see. So this is the investment conclusion that we can reach. Okay. So nowadays, with value and growth a bit more fuzzy, a lot of people like to use this market-oriented equity style. So this is more popular nowadays, right? So it's neither value or growth. And the idea of it is that, okay, we don't consider value or growth anymore. We want to see whether some companies are not priced reasonably, being underpriced, and we invest in those companies. And then at the same time, we do some management based on sectorial approach to overweight certain sectors, right? So in during COVID, if you are doing investment during COVID, a lot of people like to overweight healthcare stocks because healthcare stocks are doing very well. Healthcare research, biotech, right? So those are stocks that people like to overweight. Um, and so we do some sector rotation, and at the same time we do some uh, so-called stock picking and choosing the right time to enter the market. Right, so this is more like market-oriented kind of approach. Then the rationale is basically you want to buy a stock that's undervalued and a sector that is going to improve in the future. So based on capitalization, you can have small caps, big caps, or large caps as the different dimension in your market-oriented approach. So we can do a more return-based approach analysis as well in terms of our equity style. Uh, and when we look at the return, we can determine, okay, what style is this based on, right? So the characteristics of the portfolio will give you the style, sorry, the style. We can do either a regression, um, or things like this thing called R square. So what does R square do? R square measures the fit of the style, right? R square of a regression line. So this is going back to like your secondary school where we did regression line. Y equals mx plus c, y equals to mx plus c. And the idea is that when we do a regression in Excel, in our statistics, we will always be given this thing called R square, and R square measures the fit of this regression based on points on your scatter plot, right? Because remember how regression works is that there is a scatter plot. We try to plot a line, and the line, the lines fit gives you the R square. So using a return-based analysis, the idea is that okay, we have various returns. We plot these returns, we plot on a scatter plot, and we cut a line through y equals mx plus c. And from there, we can determine r square based, we can determine r square and hence the fit of these returns based on whether is it a what kind of equity kind of style, management style is being whether market oriented or is it a value or growth kind of equity style. Okay, you can read the rest. Uh, technique of identifying style, we can at the same time, instead of looking at returns, we can look at holding. So what does holding mean? Holding means that what are the constituents? So what are the stocks in the portfolio? So are these stocks things like Apple, Meta, Amazon? So or if you consider those are value stocks, then the style is a value stock, right? So based on the holding analysis, so you look at what's the underlying stocks in your portfolio, you determine the style. Uh, you also can infer the style not just based on holdings. You can take look at PE, what's the forecast EPS, what's the sector weighing, uh, or you can use like a more modeling approach by determining the style as well. So holding based analysis, there's this very popular way to identify style. It's called the Morningstar style box. If you are in, if you are very interested in portfolio management and you go deeper to let's say level the second level of portfolio management, you'll see this everywhere, right? Or even if you work in a portfolio management firm. The idea is that we have this box here where the y-axis is large cap, small cap, medium cap, and we have the three different stuff: value, core, and growth. Right? Core is the in between value and growth. Now, the idea is that we put the number of companies. Let's say we have 13 companies in growth, we have 60 companies in small cap, we have 17 companies in core, and based on the various capitalization. And from there, we can determine, okay, what style are you actually? You're actually more growth mid cap core growth recap. Like most of your thing is all here, right? So this is your style. So you're definitely not on value. You're more like core slash growth, and you are focusing on the large recap segment. So basically, this style box help you identify what style are you in, or what style the portfolio is. So now, I guess the overarching question is, so what's so important about this style? Like, okay, fine, you want to do value, you want to do growth, you just do whatever you want, right? But remember, at the end of the day, we are portfolio manager. We are managing our clients' money. And sometimes the client has a very specific style they want. They say, I only want to you to invest in um, value stocks, right? And this can be written in the IPS as well, as we mentioned way back in lecture one. And so the thing is, whenever as a um, as a customer of the portfolio manager, as a client, sorry, if you notice a style drift, let's say in our IPS, we say we want only growth stock, but we see a drift in style to value. That's where it's something that we're concerned, right? Because in IPS, we only mention I want a growth style investment, but if you are moving to value, that's my concern. So identifying styles become important to ensure that there is no style drift by a portfolio manager, and he's managing your money based on the mandate that you have given to him. Okay. Any pause for a short while. Any questions? No? Okay, very good. Okay, all right. So if we are still still doing well, it's a Friday night. Let's push on a little more, right? Let's think about things like investing. Okay, so we have this thing called long short investing, and the idea of it is that we we know what's long investing. Long investing means we buy a stock, we long the stock, right? Now, recall what we talked about short selling. At the same time, we can actually short a stock as well. So in the long short investing, what happens is that we long a stock, we short a stock, and by doing a combination of long short we actually boost our investment, increase our returns, of course, also increasing the risk. So let's understand how does this work. Um, the thing is, on the short sell side, most of the time, people always think about longing stocks, right? You say, oh, now the market is good to enter, to buy. But there's much lesser people talking about, oh, now is a good time to sell. So if we are able to capitalize both the long and short side, what are we getting? We are getting actually the best of both. We are getting twice the return. So that's the idea of it, right? So we do a long and we do a short sell as well. And some of the reason why we don't really think of the short sell is because there is some short sell constraint. The idea is that most of the time we can only, for us as like a individual investor, we can only short the stock if we have the stock, right? In finance term, we can only short if we have the underlying, right? That's a finance term. But in a layman term, it means that we can only short the stock if we have actually the stock. You can't short the stock that is not there. But if you are an institution, you can actually short a stock that is not, that you do not have, right? So that's where you can take a leverage and short a stock that you do not have, so that you can capitalize on the gains of using the money of the short stock to buy another stock, or if the short stock drop in value, right? Remember, we talked about two scenarios of why shopping is good in lecture two. So those are two scenarios. Just need some comments. You can have a look at it. Doesn't really impact the idea. So, so we already mentioned the idea of alpha, meaning abnormal returns. And in the long short strategy, we are actually getting two alphas, right? One from the long position and one from the short position. The risk is also multiplied by two as we're taking leverage based on the short position. Now, in a long short position, this is where risk management comes about. And in the next lecture, we'll talk about quite a bit on risk management and how we craft structured products. So we'll talk about derivative, we talk about put option, call option, etc., and how we structure products to be market neutral or risk free, right? But the idea of it now is that if we short a stock that is overvalued and we long the stock that is undervalued, and let's say they are from the same sector, okay, a lot of assumptions here, same sector, same value, same kind of risk profile, what happens is that the long position of undervalued stock and the short position of a overvalued stock cuts and negates each other such that we have a risk market neutral strategy. And this is a lot assumption because in the market it's very hard to find such stocks to do this, which is why this market neutral strategy is really used on derivatives, right? So it's used on the put options, call options. And this is what we're going to discuss in the next lecture. But if we are able to find stocks that are, same sector, equal value, one that is undervalued, one is overvalued, and then we can long the undervalued and short the overvalued, then we can get this neutral market strategy. And of course, it's the best, right? And since because what happened? Because there is no more systematic risk. We have a market neutral. This is not easy to get. Because we know that diversification reduces unsystematic risk. Then what's remaining is your beta risk, right? Your beta risk is your systematic risk. So the only way to tackle or to reduce the beta risk is through construction. Construction meaning either you do hedging, either you do a strategy kind of method, right? You cannot do it through diversification. Okay, so we have this semi-active. It's a bit of a repeat. Basically, the idea is that there are various styles of semi-active as well. The concept is that we are following a portfolio, at the same time we do some more strategic kind of asset allocate. Sorry, tactical kind of asset allocation, so that we can get some alphas, or we call it smart beta, right? Um, so the result of a semi-active is that you have higher information ratio, because remember, information ratio tracks the active returns. So you have higher information ratio now. However, your tracking error is still at an acceptable range. So we want to design a portfolio that is semi-active, that outperforms the benchmark, but at the same time tracks the benchmark, right? To get best of both worlds. Um, Assumption is that okay, we can't understand that market is efficient, things to be, we should get overall market returns. However, you believe that by doing some overweighing of the various sectors, you can actually capitalize on the market to get some smart data, quite smart data, but not alpha, all right? Or maybe alpha, but maybe it's not very alpha. And we'll talk about smart data in just a bit. So in case you're like, what's smart beta? But yeah, we'll discuss a short discussion of smart beta. The semi-active approach include things like index enhancing, core satellite, um, disadvantage that it can be very confusing, right? You use some derivative-based trading to get your smart beta. As mentioned earlier, your semi-active, you are trying to maximize, not really maximize, but you have a large, not large, but like a reasonable amount of information ratio, which gives you the active returns, right? Remember, information ratio gives you active returns, uh, while maintaining a tracking error that is reasonable, right? And your information ratio is calculated in two ways, not two ways, but in two components. First is information efficiency and investment breadth. So what does this mean? So I explained here, if information coefficient is the correlation between the forecast and actual, right? So how close are you actually tracking the forecast and actual returns, right? So that is one component of how efficient you are. Now, the investment breadth is the number of times, so it's a number of times you have to make an independent kind of investment, active investment decision. So this really tells you what is your, how active you are, right? So the number of times you have to rebalance, the number of times you have to rebuy certain stocks. So this gives you investment breadth. And the idea is that if you have a low breadth strategy, low breadth meaning you don't keep on keep on changing your asset mix, keep on doing a lot of changes. Okay, so you have less independent investment decision. If you want a same information ratio, you need to make sure that your decisions are good. Your decisions are accurate, such that your forecast and actual are very close, right? You need to make sure you have accurate insights. That's where you need to do your capital market capital market forecasting, capital market expectation. You need to really make good decisions, right? However, if your decision making, your capital market formulation is bad, you make wrong decisions, then you have to do more independent investment decisions here, right? More number of times you rebalance, more number of times you change your asset mix, right? And so these two components affect your information ratio, it gives you your active returns. Another, so for semi-active equity investing, we have this idea called core and satellite. And the idea, so these are various sub-styles. So remember, we have few talk. So just take a step back. We talked about passive, and remember we talked about some passive method. And we talked about active, and we talked about some active method of investing. Now we are semi-active, so we are going to different methods, right? And the names are a bit fancy, right? So now we are talking about semi-active, and we just take core satellite. approach. And the idea of core satellite approach is that you have a core, like a sun. How I think it's like a sun, and your satellite goes around, right? So your core is your strategic asset allocation, what is fixed for the long term. Now, your satellite that goes around is your kind of asset allocation or your tactical kind of investment strategy that you change based on market conditions, you change based on policy changes, etc. So you modify it accordingly. And that's what it means. Like core, you have a core and you have a satellite moving around. That's what is happening here. Explain here. Separation between alpha and beta. Yeah, the idea is that the alpha measures the scale of your manager. Your beta is your market risk. And so we try to separate the alpha and beta, determine how much of your returns are based on active management, how much of it is based on market returns. Okay, so this is just a pictorial example of a core and satellite. Finding the true alpha. This is something I like to talk about. Smart beta. So so a pure beta is this one, market returns, right? Return on market, RM. So this is basically your S&P 500. This is your market returns. Now, smart beta is where you do some over or underweight of certain sectors, over underweight of certain stocks because you have certain market expectations, right? But at the same time, you are still in the beta range. You're still not getting alpha, right? It's just smart beta. So you're doing some readjustment, you're doing some change. Remember earlier I mentioned about the Sharia law S&P 500 because that is overweight in technology. That's why you get higher return. So we do some smart selection, right? Okay, instead of 100%, let's say if I want, instead of a beta of, let's say 100% in S&P 500, what about if I do 50% in S&P 500, 50% in Sharia law, S&P 500? And by doing so, I actually gain a smart data of from the technology stocks because of the overweight of technology stocks in our Sharia portfolio. So these are smart data, right? Are you actively managing the portfolio to get alpha? No, but what you're doing is you are overweighing certain components of the portfolio so that you can get higher returns than the S&P 500. Does that make sense to everybody? What smart beta? Smart beta is unfortunately now it's not so popular. Popular as in it was a big discussion last 2022, 2023 is very big discussion. Now, not many people talk about it, but it's important to understand that there's such a thing. Okay, last but not least, we have alpha. Alpha is where you really actively manage, let's say, in 2020, you know that, or you have a perception that Bitcoin is going to explode, is going to go really popular, and then you buy into Bitcoin, and that's alpha, right? You really select and choose, and you say, okay, why I think Bitcoin will do well, why I think Nvidia will do well, and these are really beta. Sorry, these are really alphas, right? They're not like just smart betas. So that's the difference. For alpha, you're really selecting. You really have the kind of conviction in certain companies or conviction in certain stocks. So this is an explanation of smart beta. You can have a look at it. Basically, is what I've explained about overweighing or underweighing certain sectors, but at the same time, not really actively kind of managing the stock to get alpha returns, right? So this is an explanation. Um, so this a bit about comments counting. Can you actually beat the market? Yes, but it's actually very hard to consistently beat the market. Most of the time, you beat the market in 1 year, 2 years, maybe the third year you didn't. So on average, maybe you didn't beat the market, right? Uh, There are some cognitive biases as well that you might want to be very careful on. And the main one when investing is confirmation bias. Right, I want to highlight this. So, what's confirmation bias? It's very common in the sense that okay, I have bought into, let's say, Meta. Now, I will try to search for information. It can be very subconscious, but you try to search for information that validates your decision to buy the Meta. However, it might not be a right time, right? It could be overvalued now. It could be a bad decision because the price might not increase. It will go down later. But the thing is that because of our behavioral bias, we're trying to validate. And maybe we share the information with our friends, our family. We try to get validation, right? So confirmation bias is one of the main things in investment as a portfolio manager. So you need to be very careful on this. Of course, there's a whole suite of biases that we mentioned in lecture 2. Be a contrarian. So what a contrarian means is that if the market is going down, buy into it, right? So I think I mentioned in the last lecture as well. Now bonds are really low. So as a contrarian, you would buy into bonds now, right? Because the reason why, and we already discussed it a few times, the reason why bonds are very low is interest rate very high, right? Like if you have expectation that interest rate will decrease over time, this means that our money markets meaning our fixed deposit, our guaranteed product, the returns on this product would decrease over time because once our short-term interest rate decrease, our money markets return will decrease, right? So as a portfolio manager, it will be important for me to consider this and ensure that the fund flows from our money market for client, that is flows from the fixed deposit to bonds now. And now is the important time because we don't want to wait till the short-term rate decrease and our bond price increase and we miss the boat, right? So we are contrarian in the sense that if we see an opportunity, it's usually the reverse, where things are going bad for that category of stocks or category of securities. And in this case, bonds are the one doing the worst. And so maybe it's a time to shift our funds away from money market because we know short-term rates will decrease over time and time to buy into long-term treasuries instead to capitalize on our duration and complexity. Just some comment why passive might be suitable. Generally, on average, most active managers do not outperform the market after deduction of management fees. All right. Okay, so I think I managed to complete the lecture 15 minutes just nice in advance so that we can go through the Q&A. I know this lecture is very heavy. Hopefully the next 2 lectures are less heavy. Before we go into Q&A, any questions first regarding this lecture? There's a lot of information, a lot of things you have to review, I would say. In terms of calculations, not too difficult, but a lot of concepts to understand. I'll pause here. Any questions? Hope it's clear. So maybe you might not have questions now. If you do have questions, do not hesitate to drop me a message. Message meaning email. Usually I reply really quickly and I can help you clarify any things you're not familiar with, right? So next one, let me just quickly have a look. Next lecture, I think is not so, there are less slides, which is good, I guess. However, we'll talk quite a bit on derivatives, so credit risk and how we mitigate our risk using derivative products. So if you like derivatives, if you like things like put call options, how you structure things like a straddle, next lecture will be really fun. Okay. All right. Good. We have no questions. Let's jump straight into the TMA. So you can go into Canvas. Let me just share my screen. Okay, just give me one moment. Let me run to the toilet. I'll be back in 1 minute. Right. Okay, so let's look at the TMA now. Hopefully you have some questions or maybe clarifications you like, and then we can go through that. Before I go through questions, any comments for the TMA, any clarifications you'd like to ask? I think that would be useful because your question that you might have is something that your friends might have as well. Okay, maybe you're having a look at TNA. So I try to put as much comments as possible. So, let's just look at the question first, right? So question one is very quantitative. Question two is qualitative. Just as a background, I think most of you all did very well for question two. Question one, I think most of you all did well as well. However, there were some issues regarding question 1A, especially. Most did not get a full marks. You get some deductions. But question two generally is good. So let's try to understand this case, right? So this is a short case. I want to highlight that as we look forward towards the GDA, that is a really long case. So we need to, for those that didn't really score too well, please work closely with your teams. And we really need to add in a lot of details in your answer. So those that did not really score too well, the overall is that there's not enough details, especially in your qualitative component. So please work closely with your team to make sure that you have enough uh, explanation based on what we've covered in the lecture, right? So try to bring in the frameworks that we talk about. Yeah, so it's safe to assume that. However, let's say, okay, so the thing about this module at the same time is there's no really fixed answer, particularly for the case as well. There's no fixed answer. So if you have well-reasoned um, comments or assumptions that make sense, you will usually be given either a full mark or to the point that your assumption makes sense, right? However, if the assumptions are a bit off, then maybe get some mark reduction. However, of course, if you explain it well and manage to justify that you are given a full mark. So the good thing about I guess the good thing about this course is that because it's a very case based, there's really no fixed answer unless it's quantitative, like question one. Okay. So instead of reading the whole case, of course, I think most of you are still quite fresh into the case, so that we can focus our time discussing more of the questions. So for question one, right, I think that the tricky part is that we need to understand there are two timelines, right? Okay, so you have the case in front of you. I'll just pull out my pen to just explain this in a bit, right? So I don't explain the case like word by word, but let's just understand the concept of it. So I'm going to share my screen so I can draw. Um, okay, so in this case, right, what we need to understand is that there are two timelines in our case. So those that are very clear with the timeline usually got 2 marks for both parts. However, for question 1A, most did not get a mark. So the idea is that we have two timeline. So let me just draw the timeline. So we have two timeline here, and then we have timeline like this. Okay, so this part here is before retirement, right? And this is after. Okay, I'll just write after. And in both timeline, what happens is that there are cash flow CF and CF here. Okay, so in question one, right, 1A, when we see things like calculate the total dollar retirement needs at a point the couple retire. So what are we interested in? We're interested in, let me just pull out a different color. We're interested in the cash flows here discounted back to this point here, right? See the PV of it. Now, the part is that most did not consider PV. So maybe it goes back to more the fundamental kind of understanding is that whenever we are shifting cash flow, okay, so I always like to, whenever I teach the basic 203 financial management course, always like to instill this idea that in finance that whenever we shift cash from different years, okay, this is across the board, anything, any kind of questions. Always think about interest rate, always think about PVs. So in finance, you cannot just say cash $100 2 years from now is the same as $100 now. And so the trick that uh most most of y'all fell into is that there was a comment that they say if you look at your question, right? There's a comment that says budgeting 180K per year during retirement for expenses. Now, most people did 180K multiply by, I can't remember the number of years that you, was it, just check, was it a 25 years, right? Multiply by 25 years. And then there was a comment to say that we also need a 5 million to cover medical expenses. So most people take 180K. So what was done is this, right? Most did this 180K times 25 years plus 5 million, right? And then you get some answer here. Now, because we are in finance, we are doing movement of cash flows, the basic understanding is we cannot do this. This is a non-finance method of calculating. So we need to ensure that we consider time value of money. So we need to do the PV here. Any questions on this? I want to emphasize this because this would affect not only this course, and if you do other more advanced courses, this is like more like a basic understanding, moving cash flows. Okay, so this is my own personal. So I usually do the questions as well. So this is my own personal working in the sense of this, right? So let's look at this. I'm just going to highlight a different this color here. So okay, so we unfortunately we cannot upload any answers, and even as we go through, right, um, the school is quite strict on this. We cannot upload answers, nor can we actually show solutions, right? So this working is really just my own personal working. So I really encourage you to ask questions if you do have. But the idea, if you have any specific questions regarding questions. Yeah, this is a school-wide policy, so sorry, I can't. If not, we get a lot of issues. So the idea of it is that for question one, we do a PV plus the 5,000, so 5 million. Okay, so are there any questions regarding question 1A? So question 1B, I want to highlight that for question 1B on the test, calculate the pension fund amount. So pension fund amount would be prior to retirement. Um, sorry, will be after retirement. What is the pension fund? The question is pension fund at a point of company's retirement. So what is the cash flows for the 25 years, right? So when we do this, most of y'all manage to get the answer. So let me just share my own personal working. So it's not like the solutions which service provider. So this is my own personal working. So most people do this concept of the number of years, and then you do 25 years, and then you do like this, right? So I want to highlight something at this point in time is that this method is good. Usually you get the answer, or most of you all can get the answer using this method. Now, in case, I mean, in your final exam, as of now, I understand there is a closed book. I do not know whether you have, I think you have access to Excel, but I'm not too sure, right? So just be careful whether you to check with administrator when the notice for final exam is out. Just check whether you have access to Excel. If you don't, you might not be able to do this method here. So I want to highlight to you to use the formula method taught in your 203 class where you calculate based on growing annuity, right? Rather than like this. So the growing annuity formula. So I've wrote the formula here. However, you can Google growing annuity, and the idea is that because your cash flows are growing, and for 25 years, you need to use the growing annuity formula and the PV of it, and then after that, the FD, the growing annuity, and you get the total pension fund asset. Yeah. Some of you all did the FD growing annuity formula. This is usually not taught in our syllabus, in even the 203 is not taught. However, it's possible as well if you because it's just manipulation of the numbers. So we can do that as well to get straight away the total pension asset. And then after you need to add this, which is the existing pension. Now, on this point, I want to also highlight something that it is better to segregate. So some people, okay, so I've accepted a few different answers. Some people consider that, oh, it should be annuity due. Some people say it's a growing annuity. Sorry, growing annuity due or ordinary annuity. And I hope you know what's the difference, right? Annuity due means that the cash flow happens at the start of the year. And if you justify it that, okay, you need the cash flow at the start of the year so that you can spend it for the rest of the year, right? So if you do such justification, you usually get 2 marks. There is, even though the answer, so-called the model answer is ordinary annuity, but there's no marks deducted because it makes sense. So that's the part about this course that is slightly different. That yes, there is a so-called model answer, but then if there's substantiation and justification and it makes sense, you will get the full marks as well. I know we are at the time. Pause for a while. Any questions? So considering year zero, so this is the annuity due, yeah, annuity due assumption. think maybe no questions in the interest of time. Um, I, those that need to leave, because you have something on later, later is quite late. If you really leave, feel free to leave. I'll just try to finish up the question. So for part C, you have the question in front of you. Let me just look at what part C is. So for part C, right, is about constructing a cash flow. So most of you all have no issues constructing a cash flow. And you score the full marks for that. Now, the marks that was lost in most cases is this final mark here. Okay, so this is the part that is very important. I want to highlight to you the conceptual. So most people get this whole cash flow. Everyone did very well for this. You get the full marks. Now, the last part, right, of the question is estimate the return requirements for the couple's investment portfolio. Now, to estimate the return requirements, what we cannot do is we cannot do FD. Most people do FD. Okay, let me explain to you why. You know that there is cash coming in, because this is a net cash flow, right? There's cash coming in as we go along, right? If you are using the FD formula, we are bringing all the cash to the start of the year and what is the final year cash, and we calculate what is the rate in order to get from the starting to the final. That's the concept of FD. You cannot do that because you have cash coming in. So there's only two methods that you can do. First, some of you all use the goal-seek function. The goal-seek function is possible. However, you need to make sure that you set up your sheet properly, right? Set up your sheet properly meaning what? Okay, you use the goal-seek function and you set up the sheet in terms of a NPV. So this is going back to your 203 module. Remember NPV, what's NPV? Net present value. But the net present value is assuming the investments come in as the year go by and being reinvested at the investment rate, meaning this rate here, right? So NPV does that. So you construct an NPV and use the goal-seek, as you can see here, to determine this value here, you get this answer and you get the full marks. Now, this is the part I think that most people use the FD, and the FD doesn't consider the reinvestment of the cash flows each year at the investment rate. Any questions on this? Everyone understand what it means? So this is method one. Method two, which so far nobody use, is the IRR method. So this is also in your 203. So in FIN 203, you actually learn two methods as well. Because it's a level one mod, we didn't cover this here. But the idea is that IRR, you have a cash flow here, you determine all your cash flows, right? Your cash flows, and there is a cash outflow here, right? Given that it is a conventional cash flow, so if you can't remember what's conventional cash flow or non-conventional cash flow, I highly encourage you to review your 203 slides. To explain the idea of a conventional cash flow means that the sign of the cash flow only changes once, right? So all these are all positive, and the sign becomes negative at the end, right? So if it's a conventional cash flow or IRR method works, and so you can do IRR as well, and we get a pretty similar answer, right? But not the same. That's why in the question is said as estimation, because we are estimating. So both method works, however, the FD method doesn't work. So there's a comment here assuming net cash is reinvested into the investment portfolio. So some of you did some assumptions that say, oh, you know what, maybe the cash flows are not reinvested. But in logical sense, it's a bit tough to accept this assumption. Don't you think so? For example, if you have money coming in every year, does it make sense to say, oh, I take this money and put it in cash and don't invest it at all? A bit hard to accept. So unfortunately, I can't really give the full marks for that kind of assumption. You need to give a reasonable assumption, right? If you say it's reinvested in a portfolio, that makes sense, and therefore use NPV method as given here, or the IRR method. Uh, any questions for question one? Okay, for the interest of time, I'll just quickly go through overview of question two. Question 2A, most of you all did well if you explain the components using what we discussed in lecture one, IPS, with reference to the case, right? So if you do very like uh, not very specific kind of questions, not kind of specific kind of answers, you might not get a mark. But if you're very specific and bring in details of the case, you get the full marks, right? So no problem with that. Then question A. Question B, if you had explained it with good substantiation, usually you get the full marks as well, right? There might be some marks deducted because you need to explain things like diversification, right? So I really, for your GBA or your other assessment, even your finals, really try to bring in all the concepts that we talk about in class, right? So most of your lost marks on the idea of diversification, you need to explain diversification in the answer, right? Yes, you recommend maybe portfolio A, or you say I recommend portfolio B because of all the reasons. But then the question is, okay, how come I have money market, stock, and bonds? Why not just 100%? So you need to bring in idea of diversification and what diversification does for you, particularly for bonds. So that's the part that some of you all miss the marks at this point. And it's a 14 marks as well. So you need to be careful. Okay, that's all. Any questions regarding the TMA? Overall, the class did very well. I'm quite happy. Those that did not score too well, I encourage you to either work harder for your GBA, or uh, also if participate more in class, right? Because class part is 15%, your TMA is also 50%. So if you participate more and you didn't score too well this round, do not be discouraged. You do have your GBA and your class participation, right? So you can work on that. Okay, that's all I have. I know we went over short. Uh, any questions before we close off for today? Okay. You need to use time value of, oh, I'm sorry. I think I saw a comment directly. So some of y'all will receive a comment, please use TVM. So I might have to do a typo. So not TVA. So TVM, time value of money. So is what I talk about for the PV. So I'm sorry, some of y'all might have I might have typed too fast. So, if you do need any more clarifications on TMA, drop me an email. Thank you all for today. I know it's a Friday, it's a bit late as well. Have a good rest, have a good weekend. Uh, and I will, and if you do have any questions, GBA, TMA, or even lecture, drop me an email. Thank you. Thanks. Have a good rest.